Hello traders, Mandla here at FX Link. Welcome to our weekly trade review videos. Today we are going to talk about one of the most important but yet ignored aspects of trading, which is trading psychology, mainly focusing on the topic of greed and how to deal with the frustration of missing trades in the market. But before we get to the charts, I would like to take you back to our weekend market preparation video, and I will take it from there. Enjoy. We have our retracement, right? At this level of structure, we have our extension lining up at that level of structure. What do we have again, guys? We have previous resistance becoming support at that level of structure. Okay, mainly we will be looking for a retracement back at this support level of structure, and looking at our risk to reward, mainly you might be looking for a risk to reward which is like this. I'm setting myself up for this risk to reward, potential 76 pips worth of a move right there, and a 20 pip 24 to 30 pips worth of risk on this particular pair. Why? My logic of stop placement would be 10 pips below these levels of structure. So on this low, I'll take 10 pips right here from 81 to 71. Now, mainly on our market prep video, as you would have seen, we are mainly shooting at the resistant level right here, right? Okay, we're mainly looking for a retest over that resistant level right there. And as we go to the lower time frame, you would have seen my kill zone actually came back to these levels of structure, which was our previous resistance. Actually, this structure swap right here, where our previous resistance has became support at this level. So we were looking for a pullback, right, over this level for a potential buying opportunity at the resistance, for taking profits at these resistance levels, and mainly taking extended profits over to those resistant levels on the daily time frame. Okay, now let's take a look at what the market has done as soon as it opened. Okay, as soon as the market is opened, if we go step by step, soon as the market opened, it gapped down. As the market gaps down, mainly it shows a sign that the market does most of the times want to go lower. This was a good sign for me that the market will eventually try to retest at our kill zone, giving us a potential buying opportunity. Okay, now this is what happened in the market. The market broke out. As you will see, our high right here was broken. The market made a higher close, which was a sign that the market still wants to continue on the upside and go to our potential resistant levels. So still, we were still looking for a deep pullback at those levels of structure, of support actually, for potential buying opportunity at our extended targets, which were right at these levels. Right now, during the week, this is what happened. Right, the market retraced back. Market kind of retraced, gave us a lower low, lower close at this level, which is a good sign again, right, for a continued bearish move. Market ebbed and flowed, and then this is what happened. As soon as the market came to this gap right here, particularly as you become more experienced in the market, when you see gaps actually most of the times give psychological levels for a potential buy opportunity or sell opportunity, depending on your top-down analysis in the market. So these levels where the market gapped at, this is what the market did. It came to these levels, consolidated for a bit, for actually 2-3 hours, and then made a higher high, higher close, right? Then the market extended up, gave us what? A higher high, higher close, higher than this level. Okay, so if unfortunately the market didn't over the week, as we are in Thursday right now, okay, this is what the market is currently at right now. Unfortunately, the market didn't actually come to our support levels. Okay? Right? After all, we are human, guys. Which means that most of our decisions we make on a day-to-day basis have an emotional element to it. And no matter how rational your decisions are, mainly those decisions have an emotional element to it, right? Now, how you're going to deal with those emotions is one of the key indicators on whether the decisions that you take will yield of the desired result if you consistently deal with these emotions effectively. Okay? Now, in terms of trading, let's get back to trading. In terms of trading, this is what happens to most of the traders, right? In terms of trading, mostly greed comes off to a trader, right? Trading is hard, guys. It's a hard game to play, and most of the times, many traders fall into prey to psychological errors and fail to notice those errors, and they become doomed and become part of the 90%. Right? Let's go back to our analysis again. We identified our 618 retracement right here. Right? Let me take these off. Let me take these off so you could see clearly. We identified our 618 retracement right there, right, with our fib extension lining up, inversion actually lining up at that structure level right here, which is our support level, our minor level of structure, and our major level of structure going back to the daily time frame. Now, we planned this ahead of time. As we planned this ahead of time, we measured our risk to reward if the market goes there, and then we looking to buy at this level with stops lower than this level and targets over this at the current resistant level, and extended targets at our resistant levels that we looked at on the daily time frame. Okay, now that we have a planned, a clearly defined plan of where we want to get into the market and when we should get into the market, this is what happens. The market opens with a gap. Okay, this is a good sign that the market wants to go at my support levels. So I would wait patiently. Resistance, a good sign. Okay, now that's a good sign. Now we have a resistance. Okay, it's holding. Breakout. Breakout. Then when you see that breakout, the market is gonna leave without me. The market buy. Then you buy at market. After buying at market, what tends to happen is You made an emotional decision. After making an emotional decision, you start to forge a risk to reward. Then you say, okay, I'll take my stop. I'll put my stops below this low right here, and I'll take my targets at that level of support, of resistance actually. And that's you tend to rationalize that decision of, okay, it's not too bad of a risk to reward to take, so it's okay. I'll take this risk to reward, and I'll take this opportunity before the market leaves without me. Okay, then you buy. Okay, then you buy. Then the market does this. It reverses on a dime, stops you out. Okay, after stopping us out, what happens is, by giving in to these emotional pitfalls, okay, by giving in to this fear of missing out, what happens? We forget other opportunities that we might have from other markets, or other opportunities that we might have from other pairs that you are tracking, right? You tend to focus only on this pair, because why? You got in where you shouldn't have got in first. Second thing, you got stopped out, and after getting stopped out, that triggered an emotion of greed, right? An emotion of, I need to get back what I've lost from the market, right? And what tends to happen from there is that, first things first, you tend to break your rules of trading, right? You tend to break your rules in order for you to actually trying to get back what you have lost in the market, or trying to make up for that missed opportunity if you haven't gotten in actually at this level of structure right here. Let's say your back testing result, your strategy has throughout your back testing, if you have back tested correctly, a strategy results to a let me find something. Your back testing results to a 60% 60% probability of being right, right? You have a 60% chance of being right. Right? Let me make it a little bit larger. Let's say, first of all, you have a 60% chance of being right. As you have a 60% chance of being right, what tends to happen when you make this, when you give in to these psychological errors of trying to make up for that lost, that missed opportunity, and consistently breaking your own rules, breaking your trading plans, what tends to happen is, when you had a, say, your equity curve goes like this, right? You have slight pullbacks, and you consistently have new structure highs on your backtesting results. But when you give in to these psychological errors, and you lose sight of you actually lose sight of these errors, and you don't notice it during your trading journey, what tends to happen is, you would tend to actually have a result of this in your equity curve, right? Lower lows, lower highs. Most of the times, other times you might have this, then another time you might try to do this and have this type of scenario, end up being in this type of scenario, end up lowering your chances of being right in the market by consistently breaking your own rules. right? Now, there are ways to solve this problem, and there are ways to deal with your emotions as you get into a trade. First of all, first way to deal with your let me do this. Let me delete this. Okay. The first way that could help you to prevent this psychological error of greed and actually breaking your trading rules in this game is this is the okay, set it and forget it, right? The set it and forget it rule, right? If you use this rule and actually set your trades, place your pending order depending on what type of trader are you. If you're an aggressive trader, mainly most of the times this could work well with aggressive traders. Set your targets, set your entry, set your stop loss, and forget that trade, right? If the market didn't come to your level, scrap it off, do another analysis, right? Because if you set it and forget it, mainly you will be less prone to be making more psychological errors and to be staring at your screen all day, knowing that this is a swing trade, but you staring at the screen tick by tick by tick. That would show something is wrong with your trading. Either you have placed a position that's too high for your comfort, or either you have some sort of attachment to that trade, right? Another rule another thing that might help you to avoid this is take a picture of each and every of each potential trade you might have, right? So this is why I took this from a renowned trader, which is Alexandra Elder. He keeps on saying this: show me a good trader and I'll show you a trader who keeps records. So if you could try to take a picture of each potential trade you might have in the market, and that would mainly set you up for a commitment and consistency bias. By commitment and consistency, what I mean by that is that if you take that picture, for example, and let's say the market does this, the market is currently right here, it has violated these resistance levels. Now you want to have a pullback, right? Then you draw your pullback. Let me make it red. Then you draw your pullback and you say, I'm mainly looking to enter around this level of structure, right? After entering around this level of structure, my potential reward would be this one, and my actual risk would be this much, right? Now you have set out your plan of engagement. You've said, okay, I'm looking for a pullback. After a pullback, I will enter at this level with this much risk and this much reward. After taking a picture of this trading idea, it will mainly set yourself up for sticking to that trade idea and leave all the Mr. All and avoid what could happen is the market could actually come a little bit close to your level, then go to those levels of structure, but you won't be prone to take each and every trade that wouldn't meet your trading criteria, and you will be prone to actually sticking to your own rules and your trading plan. So that's actually quite good, right? Last thing, actually, let me take you back. Let me take you to a book that I've been reading, so I can show you the last thing that you might want to take from this book. This is a book called The Daily Trading Coach: 101 lessons for becoming your own trading psychologist or psychology coach, whatever. Right? Oh yeah, it's currently here. He says, when we keep a psychological journal, I advise for you guys to keep a psychological journal. The learning principles are not so different. At first, the journal is simply a tool for recognizing your own patterns as traders. These include, first things first, behavioral patterns, tendencies to act in particular ways in given situations. Right? When the market doesn't come to your level, how do you feel? How you actually feel uh, during that process of maybe a retracement, or actually during the process of retracement, seeing that the market is actually leaving, uh, is actually going without you, leaving without you. Emotional patterns, tendencies to enter particular moods or states in reaction of particular events, just like what I've explained. If you see that breakout, what what tendency do you actually what emotions do you actually have when that happens? Okay, cognitive patterns, tendency to enter into specific thinking patterns or frames of mind in the face of personal or market related situation. I hope you enjoyed this video. If you did, please subscribe to this channel and click that like button, share with your friends, and continue pushing that positive energy throughout as many people as you can. So, for me, Mandla, I'll see you on the next trade. Have a great weekend. Goodbye.